It's 11 and a half minutes past 7. Mortgage rates then have started to drop after the official cash rate was cut by 25 basis points yesterday. So what does it mean for your home loan? And is now the time to break your fixed term? Joining me is loan market mortgage advisor Bruce Patten. Bruce, good morning to you.
Morning.
Thanks for joining us. Okay, is it time to break your mortgage?
I think for some people, if the cost's right, it is. Probably was right two announcements ago, really. But with what's been said, and if the chances are we're going to go down to 2%, then absolutely, why not get into it?
And I mean, that's the great thing about now. Not only do we know what the rate is now, but we have very clear advice that that rate is going to get lower.
Absolutely. So at least 0.5% lower. If you're a gambler, possibly 1%, and depending on where the market goes.
Okay, so if you break fixed, you're not going straight onto a newer, better fixed. You would stay floating for a while. What would you recommend?
Yeah, no, I'd disagree. I'd probably go 6 months. Now, the reason for that is you're floating at 6. Your 6 months is under 5. Mm-hmm. So you're saving 1% for the next 6 months. And most people don't realise that within 4 months, you're in a position with most banks
where
to
you
look
can
at refixing.
Yes, so without a break fee.
Correct.
Okay, so what you would recommend is once you have broken, if you do break, you fix for 6 months.
Yep, absolutely.
And then start looking at renegotiating after 4.
That's right. Because there's no risk that we're going to see the rates go up anytime in the next 6 months.
Yeah, which is the great thing about making a decision now. You made another point just now. Probably you should have done it a couple of months ago. If it is right for you to break, the sooner you do it, the better.
Absolutely. A lot of people think I'll wait to see if they go lower. The lower the rates go, the higher the break costs go up. So sooner rather than later.
Okay, so what is the calculation that someone has to make to determine whether or not it is right for them to pay the break fee?
So there's two things. Firstly, look at whether your benefit is going to be greater than your cost. So if it costs you 5 to get out and you benefit by 7 between now and when your rate was going to mature, then there's a good reason to do it. Secondly, if it's an affordability thing for you, if you need to bring your costs down because circumstances have changed, family, gone to one income, then you might do it even if it isn't a benefit to you. And thirdly, if you're in Auckland, you look at the house prices, you might go, it's going to cost me 10 grand, but in a month my house has gone up by 20, so why not take the hit now and see where things pan out?
Yeah. All right, so people need to be doing that now if they're not up to doing it themselves. Is this something that you can talk to your bank about, or should you be talking to a broker or an advisor rather than your own bank?
It depends on your relationship, but most people, the amount of people coming to advisors is unprecedented. The volume of people that we're seeing is so much greater than it has been any time in the 15 years that I've been involved in it.
And I'm right, aren't I? You've got to own it. You can't just sit around complaining and saying, oh God, I shouldn't have fixed, but I did, and now my life is shite. You've actually got to own the thing and do something about it.
Absolutely. And a thing that I think a lot of people need to realise is they have signed a contract for a fixed period. It would be unlikely for a bank to come to you if you had an 8% term deposit and say, sorry, rates have moved.
They're never going to come to you and say that.
Yeah. So don't be angry at the bank. It is a cost. It's a genuine cost to them. You have to decide whether you're prepared to pay that cost and go on to a better rate.
Yeah, and the reality is the only reason you got the rate you got is because you made an agreement. You made a written agreement to hold that rate for an amount of time. So penalties are entirely the right thing for a bank to charge. Bruce, just very quickly, the flip side of the coin is this is very, very bad news for people that are living off their investments. Now, for people with fixed-term investments, which are probably still only earning them now about 4.2% or something, when they come off, a lot of people are going to be saying, there's no point having money in the bank at all. I'm just not making enough. They're going to be looking around to buy an investment property. They're going to be looking around to pick up a cheap mortgage and invest in something. Is that a concern? Should there be warning bells there?
Yeah, I think there's two parts to it. The first part is that this is going to go on for some time. So these poor old investors are going to have low interest rates for some time to come. In terms of whether it's the right thing, Hannah mentioned it earlier that, it's what's right for you. Investment properties are not right for everybody, but yeah, it could certainly fuel a bit of activity in that space.
But if you need interest to live off, if you need income to live off, then termed investments are not right for people either. Yeah, tricky. Bruce, thank you very much for joining us. Bruce Patten, Loan Market Mortgage Advisor.